We spoke about this a little bit earlier, that whenever you arrive at the profit as per the profit and loss account, then there are various adjustments which are to be done in the form of addition. Let us now see each one of them in a little bit more detail. The first one is expenses which are not allowed for income tax purpose but debited to the profit and loss account. So what can happen is, let's say for example, this is your profit and loss account. Okay, your income or the revenue, let's say, is 100. You have booked an expense 1, 2, 40, 30, and you said my income is 30. Right? This is how your profit and loss account is depicted. Now there could be a situation where an expenses which you have taken as 30 is not allowed as a deduction for income tax purposes. So when you prepare your tax computation, you will say my income is 30, but the tax office will say no, this expense is not allowed. Okay, so you have to then add it on to this to increase your taxable income to 60. Why? Because you have booked an expense which is not allowed for tax purposes. And when I'm proceeding here, I'm proceeding that this is a profit. Right? In all the examples that I'm taking, I'm assuming it is a profit. In case it's a loss, what happens is that instead of adding this, you will reduce the amount of loss. So let's say for example, if I had here not 30, let's say 80 of loss, then I will reduce this loss because this is minus, this is plus. So minus plus gives you minus. So you will write minus 50 or the loss of 50. Right? But for our example purposes, we are assuming here you are in a profit. So this is the first type of expenses which are not allowed as per the income tax. If these are coming in your profit and loss account, that means you would have shown a lower amount of income which needs to be increased, and therefore this adjustment is added. Second, income or receipts which are taxable under PGBP but have not been credited to the profit and loss account. Again, let's say I prepare my P&L. Okay, I show my income at 100, but I expense as 40 and income as 60. Right? But the tax office came and said, look boss, there is an income 2, let's call it, of 50 rupees which you haven't included in this. You should have ideally included this here. If I would have included this here, then what will be my income? Which will be 100 plus 50, 150 minus 40, okay, which will be 110 instead of 60. So therefore, in order to arrive at the correct income, what I do is addition is made to my P&L number. So if my P&L was 60, I add this income which has not been added to the P&L account and arrive at 110. Please note that each of these adjustments flow from logic. If you apply the correct logic, actually you don't need to mug up things. And that's the way a successful chartered accountant is made. Don't mug up anything anytime. Then you have excessive expenses debited to the profit and loss account. So if, let's say for example, an expense which is allowable is only 40, but you have booked 60. Right? So what will be the impact of booking an excessive expense? If you book an expense more, your income goes down. To increase your income, to reinstate this, if this is 40, you will have to make an addition for this. Loss is not allowed but debited to the profit and loss account. This is something similar to the first adjustment. So if you've booked any loss, let's say loss on sale of asset. This is not a revenue expenditure. So if you've booked it in the profit and loss account, it's something like an expense which is not allowed but debited to the profit and loss account. So you need to remove the impact of this, which is removed actually by increasing the P&L. Expenses not relating to the previous year but debited to the profit and loss account. Again, something like, you booked an expense of 40 for some last year or the next year, an advance payment. Now advance payment is to be allowed as a deduction in the coming year, right? And what is pertaining to the last year is a prior period item. That is not allowed as a deduction. So if there is any case of such expenses, you have to nullify their impact. And how do you do that? You make an addition to the profit and loss account. Expenses not allowed but debited to the P&L. This is again something which is there in the first clause. Other expenses to be discussed subsequently, like personal expenses, differences in stock valuation, etc. We'll discuss this all subsequently. But all of them are some expenses which are not allowed, right? Okay, the key thing to be kept in mind is addition to the profit as per profit and loss account. If it's a loss, all these items are to be reduced from the loss. Okay? With that, we come to an end of this slide. Let's move on to the next one.